All right, today we are cracking open the books on a really fascinating company in the travel tech space, Accelya Solutions India Limited. We're going to dive deep into their financial reports, decode the numbers, and see exactly what kind of story they're telling. So here's the game plan. First up, we'll get to know who Accelya is. Then we'll trace their revenue journey, figure out how that income actually turns into profit, give them a full financial health check, and then, at the end, wrap it all up. So first things first, who is Accelya? Before we get totally bogged down in spreadsheets and financial statements, let's just answer the most basic question. What does this company actually do? It's actually super straightforward. According to their official filings, Accelya Solutions has a laser focus. They operate in just one single segment, the travel and transportation industry. That's it. No side ventures, just one core business. Okay, let's get to the juicy part, the revenue growth story. This is where we look at the company's top-line performance. We're talking about the total amount of money coming in the door before a single expense is paid. Now, to really get the full picture of their journey, we've pulled data from 3 key moments in time: late 2019, early 2022, and late 2024. And believe me, together these 3 snapshots tell a pretty incredible story of challenge and, well, recovery. Let's rewind the clock a bit back to the end of 2019. In that quarter, Accelya's revenue was clocking in at around 113.6 crore rupees. That's a solid number, and it's going to be our baseline for this whole story. But then, as we all know, things got really, really tough for the travel industry. By the first quarter of 2022, that revenue number had dropped down to about 83.2 crore rupees. That's a pretty significant dip, and it really shows you what a difficult period that was. But here's where the story gets really good. Fast forward to our latest data from the end of 2024, and just look at this. Revenue has surged to 124.3 crore rupees. They didn't just get back to where they were, they've actually blown past their 2019 levels. That's some serious growth. And this chart just says it all, doesn't it? You can see it so clearly. The dip from over 113 crore down to 83, and then that powerful climb right back up past the starting line to over 124 crore. That is a classic V-shaped recovery, and it's exactly what you want to see to know a company is resilient. Okay, so revenue is way up. That's great news, right? But it's only half the story. Now we've got to look at how they get from all that income to actual profit. Because you know what they say, it's not what you make, it's what you keep. There's that old saying in business, revenue is vanity, profit is sanity, but cash is king. A huge revenue number looks impressive, for sure, but it's the profit that tells you whether the business is actually healthy and built to last. So let's break it down. How do they get from that top line to the bottom line? Well, in the latest quarter, their total income was about 127 crore rupees. Then you subtract their total expenses, which were around 85.5 crore rupees. And what's left? A very healthy profit before tax of about 41.5 crore. Right, so that 85.5 crore expense number kind of begs the question, doesn't it? Where did all that money actually go? What are the biggest costs for running this business? And this is pretty wild. Look at this breakdown. Over 90% of their entire expense base is in just 2 buckets. First, at almost 42%, you've got employee benefit expense. This tells you right away it's a people-driven business. The other, and even bigger slice, at nearly 50%, is just this broad category called other expenses. Everything else, depreciation, finance costs, it's all just a tiny piece of the pie. All right, so we've seen money in, money out. Now it's time for a proper financial health check. This is where we pop the hood and look at the company's balance sheet to see how stable it is for the long haul. The core idea here is simple, right? You want to own more than you owe. And for Accelya, the numbers are just fantastic. As of their latest filing, they have about 373 crore rupees in assets, stuff they own, and only about 107 crore in liabilities, stuff they owe. That is a very, very strong position to be in. But honestly, if there is one number from this entire report that just makes your jaw drop, it's this one: 0.00. That's their debt-to-equity ratio. And it's not a one-time thing. It's 0 across every single period we looked at. So, what does that even mean? Well, the debt to equity ratio basically measures how much a company is using borrowed money to run its business. A ratio of 0 is, well, it's perfect. It's the best you can get. It means Accelya has absolutely no debt. They're funding their own growth, their own operations. That is a massive sign of stability and financial freedom. Okay, so let's put all the pieces together. We've gone through the revenue, the profit, the balance sheet. After digging through all that, what's the big story here? What do the numbers really tell us? Here's the bottom line. First, we saw that strong V-shaped revenue recovery. That's resilience. Second, they're consistently and healthily profitable. Third, their main costs are their people. And finally, and this is the kicker, they are just extraordinarily stable with zero debt. These 4 points, they paint a picture of a really well-managed business. And that just leaves us with one big, forward-looking question. A company that has recovered this well, is this profitable, and has absolutely zero debt? Well, they have a ton of options. So the real question is, with all that financial firepower and stability, what's the next big strategic move for Accelya? I guess that's what we'll all be watching for. Thanks for tuning in.